Welcome to Finance Files, a podcast hosted by yours truly, Whitney Coford, and my best friend, Brittany Carter, with occasional appearances by my dad, Greg Coford, and other guests.
We talk about all things finance, including investing, trading, economics, capital markets, and business management. Learn the investor mindset with us.
Disclaimer, this is not investment advice. It is purely for entertainment purposes, so make sure to do your own research. And today, Brittany is going to tell us a little bit about the history of due diligence.
Yes, so this is a little bit the history of due diligence and then also the history of the public markets, because it was one of those things where we'll get into what research looks like now with ChatGPT, because my little sister kind of blew me away and I'm changing my due diligence process accordingly. But I was like, because, we talked about this before. The first publicly traded company was the East India Company in 1602. And obviously the internet did not exist yet. They didn't even have telephones. So I really wanted to know, how did people get their information and purchase this stock? So actually, early stocks were before even stock exchanges exist. And funnily enough, stocks were written on sheets of paper, and investors would get together and trade these stocks with each other in coffee shops. So coffee shops were actually the first, quote unquote, stock
exchange.
Yes. The first stock exchanges occurred in coffee shops.
Excellent.
But yeah, so I thought that was super interesting to learn. And in terms of due diligence, you would essentially have to go to your local library and have to just kind of research from there, find random books where people had discussed the topic. And then if you wanted to see a company's financials, you would have to physical mail, snail mail, snail mail them and say, hey, I would like your financial details. They would have to pay to have the financial documents printed out and sent to them. So it was definitely a significantly longer turnaround, and that's why.
And I just want to, sorry to interrupt, Britt, but I just want to emphasize that mail was so much slower than it is now.
Yeah.
If you were in the US and you were trying to get a response from a European, that would be an 8-month plus process. And that's if you were your letter arrived and then their response made it to you. And that was not even guaranteed. So mail took forever. So you had to really believe in a company. Anyway, continue.
Yeah, I actually love that you brought that up, Whitney, because I think when people are thinking of this also in context, they're thinking of right now where you can buy stock in basically any company that's somewhat large, generating, millions in terms of valuation. This was mostly limited at the beginning to shipping companies. So ships, when they did these voyages, it was obviously super expensive to get the ship, get the crew, get all the way out there. And so they started issuing those stock. And then also the East India Company was the first to kind of say, hey, rather than just pay for one voyage, we have 10 voyages and, maybe 2 of those voyages are going to make most of the returns, a few lost at sea, a few break even, but we have the mitigated risk of being all together, right? And so it was kind of limited in terms of what industries were using it and why. It didn't really get big and start being a thing until even the London Stock Exchange was actually, that one was in 1825, but it was very limited because London, they had been issuing, a lot of shipping companies it was kind of the equivalent of, let's see here, crypto, where everyone's like, we have a crypto company, and then half of them weren't worth anything. A ton of companies were like, we have a shipping company, and these companies would get hyped up and increase in stock value really quickly and then just disappear off the face of the planet the next day. So London really restricted things. So even the exchange that they first opened was very, very limited. It didn't really become as big of a thing until the New York Stock Exchange, which is interesting because there was the Philadelphia Stock Exchange, but the New York Stock Exchange was kind of the one that really became the big shot and started making trades kind of more of a common thing that people did. And so the due diligence concept as like a legal term occurred in 1933 through the US Securities Act. And it was basically just an act endorsing a law against dealers accused of disclosing inadequate information regarding a purchase of property or securities to investors. So we kind of mentioned your research was, going to the library, asking for these. A lot of times you were just going to rely on the broker, right? And you'd be like, hey, what's the information about this? Tell me. And that broker would be getting all this information. So if you're not getting that firsthand and you can't go on the internet to look it up, it'd be very easy for them to be deceptive. And that's where the US Securities Act came in. It was like, hey, you guys need to not be jerks, and you need to tell them about all the potential risks and implications of investing in this stock. To be clear, though, there were other companies, like a ton of shipping companies copied this exact model. It made so much sense. It was a way for them to get financing without going to Columbus ended up going to Princess Sophia for, heading to India, aka America. It was like you either had to go to a super wealthy person that could front the whole bill. This was the first opportunity to say, hey, let's just get 10 people or 100, whatever it is, people to foot the bill. So this was a common thing. It wasn't just that. And that's why, yeah, again, like I said, the London exchange was so limited because they had so many bubbles per se, with people just kind of not actually having, people not doing due diligence and investing in shipping companies that weren't going to set sail.
Got it. Okay.
Yeah.
So, yeah, so that's a good segue into the importance of doing due diligence. And it sounds like it used to be so much harder to get the information. But on the flip side, I would also argue that the information was potentially more reliable than, I feel like now we probably have, and this is kind of what we talked about last week, is you have to really sort through a lot of fake news or incorrect information, make sure your sources are more accurate, versus if you're getting information from, the library or a broker, that's going to be, right, more reliable than if you're just on Wikipedia or the internet Googling. So there's, I think, pros and cons.
I mean, I would both agree and disagree. I think things were so much slower moving that it was probably just a bit easier to make an estimate as to how things would go performance wise, right? That being
True.
said, I don't know if all the same I don't even, when was the census started? And I don't think a lot of these things were being tracked the same way that they are now,
Yeah.
if that makes sense, right?
Yeah, now it's a little more formulaic.
I think now they're more equipped to easily report things. I'm sure the IRS was not nearly as robust back then, and Securities and Exchange Commission had less ability to provide oversight, because if you think about it, you could probably just mail someone whatever financials you wanted if
There's no way for them to know. Well, and by
yeah,
the time
so
they receive them, they might be completely outdated, right? So,
exactly. And I would say too, just being able to better understand the market as a whole, right? And you have better analyst coverage. Things move faster, but I do think that the due diligence, I would say overall, I think it's definitely much easier now. And I think as long as you're getting your information from the right sources, it's just as, if not more accurate. So make sure you're looking at a company's actual financials, not just pulling from Joe Schmo. And when you're looking at market data, if you can see where their sources are from and things like that, and what was their methodology, right? So at IBIS World, we had some reports that I had full faith in the numbers because it was from government reported data. That being said, there's two caveats to that. One, I've talked to industry experts within those industries, and they'd be like, oh, that's wrong. Whatever the government has, because of just the way they maybe slice and dice an industry or something, right? But then two, sometimes you just have to go based off certain conjectures rather than raw reported data. So sometimes you have to double click into that. I would say diversification of sourcing and seeing if there is an outlier is one of the best ways to protect against that. So like when I was doing our due diligence for these companies, I was like, okay, what, like this is the number coming from, you can Google and it's like 5 different report things. How aligned are they? Is there one that's like
Right.
drastically off from the others? That's helpful because if you're seeing that multiple sources have the same story, that's probably correct, right?
Yeah, for sure. And again, we've hit on diversification, not just in your portfolio, but in your sourcing. Yeah, I love
Yeah.
that.
Well, it's funny too because I feel like now we're entering another age of due diligence where when I started doing the due diligence, I was kind of doing my stereotypical analyst, like pull these figures, going to start deep diving into all these annual reports. And then my sister was like, use ChatGPT. And I was like, I'm just going to test to see how like far I can go with this. And the numbers, obviously, if I was making a massive financial decision or I was like still an analyst and like, I mean, Mark Zuckerberg was reading my reports, I'm going to make sure it's right. Like I would go to the actual financials. But if you're just doing like an initial search, go to ChatGPT and it literally, I like gave it all the different like revenue, EBITDA, PE ratio, like all the figures I wanted. And it spit it out for the company and all its top competitors. And I could just
And the
analyze the
math
data
was
that way.
correct.
Huh?
Did you double check the math?
I mean, look, I would if I was making an investment decision, but if you're doing the initial check, because one of the
Well, the reason I
companies,
ask is because depending on what type of chat GPT, like if you're using chat GPT or whatever AI you're using, if it's not all of them can do math. So that's why I'm like, check the math because
oh, I
it's really,
agree. Yeah,
yeah,
big, huge asterisk. You should double check the numbers, but if you're just doing a preliminary search to better understand an industry, and
right.
they do, ChatGPT does cite the sources, so you can then double click into those and check. But yes,
Okay,
like
that's
you're,
good.
yeah.
Because I've also heard of ChatGPT creating fake sources. So that's why I'm like,
Really?
ooh, I don't know if ChatGPT is quite ready for like to fully support due
Oh,
diligence, but
no,
you
I
may
never said fully
so,
support Whitney. I'm not going on the record as that. I do think you should absolutely be like double checking any numbers that you're pulling from there. But it is good if you just want high level to check if you're even remotely interested. Because
yeah,
one of the
yeah,
companies we covered, I did that and I was, and also too, you have to think about like how easily would ChatGPT be able to query that data. These are
right.
large companies that have a lot of coverage. So I'm like, wasn't worried about like, are they trying to scrape this from some obscure PDF on the company site? Like,
Sure.
and it was very clear, like early on, that that wasn't a good. But yeah, I agree. Like, I totally agree.
No
We should not be
spoilers.
playing. Yes.
Awesome. All right. Well, I feel like we've had a really long lead up to Think Like an Investor Thursday. So, the wait is over. Join us tomorrow, and we're going to talk about how to actually do some due diligence.